Yes, sir.
Now let us go ahead and take on this example, testing our knowledge on IND AS 103 business combination and IND AS 110, that 110 on consolidation. Now let's go ahead and read this question. In this example, you have been asked to prepare a statement of profit and loss, both the sections, the profit or loss and other comprehensive income, and also prepare a balance sheet of the holding company, right? That is a consolidated balance sheet. Now let's go ahead and take on the question. Yes, ma'am.
On 1st June 20x0, Premier acquired 80% of the equity share capital of Sanford.
Now let us say Sanford is a company initially owned by you people, and I bought 80% of Sanford shares from you people, right? Now you people will be holding only 20% from 1st June onward. That means what? You'll become the minority shareholders, or I should say non-controlling interest. On from 1st June onward,
20x0.
I bought 80% shares in your company. Then
The consideration consisted of two elements: a share exchange of 3 shares in Premier for every 5 acquired shares in Sanford, and $800,000 cash.
you saw I'm going to make two payments to you. One is going to be payment in shares, another one is payment in cash. I'm going to offer 3 shares to you people for every 5 shares is sold to me, right?
Yes, sir.
So 3 shares in my company for every 5 shares is sold. And also pay how much in cash?
800,000.
It is $800,000 in cash. Next.
The share issue has not yet been recorded by Premier.
That means I haven't recorded the share issue to you people in my books. Next.
At the date of acquisition, shares in Premier had a market value of $5 each. Below are the summarized draft financial statements of both entities.
You know, they given the market value of 1 share in my company because for you to calculate the purchase consideration, remember I'm offering 3 shares for every 5 shares. Those 3 shares offered will be valued at $5 each, being the fair value of shares, that is my company shares. Yes, ma'am.
Yes, sir. So extracts from statement of profit or loss for the year ended 30th September 20x0.
Okay.
So both are dollars in thousands.
Mm-hmm.
Revenue 92,500 for Premier, and for Sanford it is 45,000.
That will do. In thousands.
Yeah.
That will do. Then next.
Cost of sale 70,500 negative and 36,000 negative.
Okay.
Then gross profit 22,000 and 9,000.
Okay.
Other expenses 12,000 and 5,100.
Okay.
Then profit for the year is 10,000 and 3,900. Now other comprehensive income, gains on revaluation nil and nil. Total comprehensive income 10,000 and 3,900.
Okay.
Then statement of financial position as at 30th September 20x0. Assets, non-current assets, property, plant and equipment 25,500 and 13,900.
Okay.
Investments 1,800 and nil.
Okay.
Current assets 12,500 and 2,400.
Okay.
Then total assets 39,800 and 16,300.
Fine.
Then equity and liabilities, equity share of $1 each, 12,000 and 5,000.
It is 5,000, right? That is your company share capital is 5,000 in thousands, and these are $1 share, right? Face value.
Yes, sir.
That means there are 5,000 shares in your company. That is in thousands, right? That means 50 lakh shares.
Yeah.
Of these, I hold 80%. Next.
Other equity reserve, 30th September 20 W9.
That is a year before. That is VRNX 0. What is the previous year? W9. Okay. What is given?
So referred note 4. 500 under Premier and nil under Sanford.
And nil under Sanford. Next.
Retained earnings 12,300 and 4,500.
Retained earnings are 12,000
300
and
4,500.
so 4,500 no is a that is in thousands, right? That is a retained earnings of your company, Sanford.
Yes.
Of this I can say refer to the P&L. Of these I can say $3,900
Yeah.
will be the profit made in the current
year.
year. That means there is a balance of $600 would have been there as on September 30 W9 or as on 1st October W9. That is the opening balance of retained earnings. Is that fine? Have this in mind. Next.
Liabilities, current liabilities 15,000 and 6,800. So total 39,800 and 16,300.
Yes.
The following information is relevant. Number 1. At the date of acquisition, the fair values of Sanford's assets were equal to their carrying amount with the exception of its property. This had a fair value of $1.2 million below its carrying amount.
That means a fair value is something below. That means now there is a downward revaluation of assets of the subsidiary company, right, at the time of acquisition. 1.2
million.
Nothing but 12 lakh dollars, or in thousands it's going to be 1,200 in thousands. That is 1.2 million. Okay.
And had a remaining useful life of 8 years at the date of acquisition.
Another 8 years from 1st June X0. It had 8 years life. Next.
Sanford has not incorporated this in its financial statement.
That means Sanford has not accounted for this downward revaluation. As a result, even the depreciation number will be wrong, right? So you are supposed to adjust those two for the purpose of consolidation. Next.
Number 2. Sales from Sanford to Premier throughout the year ended 30th September 20X0 had consistently been $1 million per month.
You saw that that is Sanford has been selling goods to Premier at $1 million every month. Okay.
Sanford made a markup on cost of 25% on these sales.
These are given for you to remove any intra-group sales, right? And also remove any intra-group profit not yet realized. Is that clear? That's why it's given even the profit percentage.
Yeah.
Next.
Premier had $2 million at cost to Premier of inventory that had been supplied in the post-acquisition period by Sanford as at 30th September 20X0.
You know, whatever goods is supplied between June and September X0, of the $2 million worth of goods lying in stock with me. On that, you are supposed to make a provision for unrealized profits and remove it. Next.
Yes.
And your point to note is an upstream where the goods are sold by the subsidiary to the holding company. Point to note. Next.
Number 3. Premier had a trade payable balance owing to Sanford of $350,000.
$350,000 payable by whom?
By Premier had a trade payable balance owing to Sanford.
So I am supposed to pay your company. I say your because it was your company once upon a time, right? Now I control your company. Next. The trade payable $350,000.
As at 30th September 20X0.
Okay.
And this did not agree with the corresponding receivable in the Sanford's book due. Due to a $130,000 payment made to Sanford, which Sanford has not yet recorded.
You saw that Sanford has not recorded the $130,000 what you paid. Got it? So what happened is that is a trade payable of Premier includes a $350,000, right? Payable.
Yeah, so Premier paid.
But this did not balance with the amount shown as receivable in the books of Sanford. That means what? Now there is a problem. It is an intra-group and there is some cash in transit. Now I will tell you how to, don't bother. All these are intra-group balances. I will tell you how to eliminate this. Just do not get flustered or agitated. Okay. Just stay cool. Fine.
Yes, sir.
Yes.
Fourth one, previous investment include investments in shares which at the date of acquisition were classified as fair value through OCI, FBT-OCI. The investments had increased in value by $300,000 during the year. The other equity reserve related to these investments and is based on their value as at 30th September 20 W9.
Just come again with this point.
Premier investment include investment in shares which at the date of acquisition were classified as fair value through other comprehensive income, which is FBT-OCI. The investment have increased in value by $300,000 during the year. The other equity reserve related to these investments and is based on their values as at 30th September 20 W9.
Now, please refer to the just let's go to the balance sheet. You find the investments in my balance sheet.
Yeah.
Worth 1,800. This includes what? The $800,000 what I paid you guys for buying the 80% stake in your company, right? Because I recorded the cash component. That means the balance 1,000 represents
1,000
investments in some equity instruments that are classified as fair value through other comprehensive income. Understood?
Yes, sir.
And also refer to the balance sheet under equity. You have other equity reserves of 500 under Premier.
Yeah.
That represents that is OCA reserve created in the past for these investments. Is that fine? And that is a bit of IND AS 109 on financial instruments. Now it is given on September 30 X0. These $1,000 investment on the asset side, the other investments are worth 1,300. The fair value is $300 extra, right? Now you suppose to record that increase. Yeah, and you all know what is the entry for that. You'll be debiting investment and crediting other comprehensive income hyphen fair value reserve. Is that clear?
Yes.
Next.
So there were no acquisition or disposal of any of these investments during the year ended 30th September 2080.
That is why I was able to compare straight away 1,000 and the increase of $300, right? When I say 300, 300 in thousands. Next.
5. Premier's policy is to value the non-controlling interest at fair value at the date of acquisition deemed to be $3.5 million.
So remember, as per IND AS 103, always acquirer, that is a holding company, in this case a parent entity, a Premier, has a choice, right, to value the non-controlling interest either at proportionate net assets or at fair value. But here I have chosen the fair value approach. I decided to value the non-controlling interest at its fair value. Now, have they given the share price of NCI, the shares of Sanford?
No.
Or read further.
There has been no impairment of
Now, what is the fair value
consolidated
given?
goodwill. That is $3.5 million.
Oh, they given the amount itself.
Yeah.
Oh, very good.
Deemed to be.
Deemed to be $3.5 million. They're giving the share price of your company, Sanford. They're given the fair value of non-controlling interest. Yes, ma'am. And there's no impairment of?
Goodwill.
Very good. Okay. So now we shall go ahead and take on the, that's
Requirement.
it. What has been asked for?
Required A. Prepare the consolidated statement of profit or loss and other comprehensive income for Premier for the year ended 30th September 2080.
Okay.
And prepare the consolidated statement of financial position for Premier as at 30th September 2080.
Nothing but you have been asked to make a consolidated balance sheet.
Note, ignore deferred tax impact.
Oh, super. Okay, no deferred tax arising from the downward revaluation of asset, right? And also on any stock transferred by a subsidiary to the parent entity. Is that fine?
Yes.
Good. So now we shall go ahead and take on the solution. What I will do, first I'll discuss working notes 1, 2, 3, 4 and 5 and then complete the balance sheet, right? Then I will take on working note number 6 and 7 and discuss the statement of profit and loss. Shall we?
Yes, sir.
Now let us go ahead and take on a working note. Now guys, you got to have some patience, right?
Yes.
It's a very important sum. This can come for solid 15 to 20 marks in your examination. Now let us go ahead and take on working note 1.
Working note 1 is a group structure.
Exactly. I am holding 80% shares in your company. And what is the acquisition date?
1st June 2018.
That means what? I bought the shares on 1st June X0 and the balance sheet date is September 30 X0. That means 4 months will be the post acquisition period. Have that in mind. Okay?
Yes, sir.
Yes, ma'am. Now tell me 80% I hold. That means balance?
20% non
20%. You guys are now minority shareholders. But don't use that phrase. Use the phrase non-controlling interest. That is working note 1 done. Working note number 2.
Net assets at acquisition date and post acquisition retained earnings.
We are going to find both. Okay, just see the chart.
Yes, sir.
So the net assets on acquisition date means I want the net assets on 1st June X0. So what you're going to do, you can take the share capital of your company, Sanford. How much? 5,000
5,000
in thousands. And take other the retained earnings as on that date. How much? We know it is 4,500 at the year end given, right?
Yes, sir.
Please remember, that is the year end is 4,500. But what is the opening balance?
3,900.
So we know profit for the current year.
600 is the opening.
Exactly. So we know the profit for the current year is 3,900. Of these $3,900, we know the last 4 months is not. It is not profit on acquisition, right? Remove it. From the $4,500 includes profit for the current year 3,900. Of that, what is the 4 months profit? It is 3,900 into 4 by 12, which is 1,300. You minus it from 4,500. How much you get? $3,200. Have they shown the working?
Yes, sir.
What are they given? 4,500.
4,500 minus within brackets 3,900 into 4 by 12.
That means what? I can also argue this way. The $4,500 includes opening balance how much? $600. Have it aside. And then I can take $3,900 into 9 by, or rather 8 by 12 will be pre-acquisition, the first 8 months.
Yes, sir.
If I do that also, I'll get how much? I'll get 600 plus 2,600.
3,000.
I will get $3,200. If you don't trust me, no, being would-be auditors, please use a calculator and check it. Okay?
Yes, sir.
So it is going to be $3,200. And then what is the next?
Next is the property fair value.
Exactly. Remember the downward valuation?
Yes, sir.
It is 1,200 in brackets. Because there is a downward valuation, so 1,200 is subtract. And what is the net amount?
7,000.
And that is a fair value of net assets of the acquiree, Sanford, as at acquisition date. So how much? 7,000 in thousands, right?
Yes.
It is $7,000. And then next working, I mean in the same working,
retained earnings.
very simple. What I should do? $3,900 into 4 by 12. How much? 1,300. Or I can do 4,500 minus
3,200.
Exactly. It's up to you.
Yes, sir.
Either take the profit for the current year $3,900 into 4 by 12, 4 months profit, or from the closing balance minus retained earnings on acquisition date. So how much you get? 1,300. Point to note, guys, don't rush. From this, I'm supposed to add back. Remember, since there is a downward valuation of asset, the depreciation expense will reduce accordingly. So that should increase your profits. Yes or no?
Yes, sir.
And also, there are some goods sold by you people to me. And of that $2 million worth of goods are lying in my inventory, on which would have made some profit. Now, please remove the PUP. What is PUP? PUP, provision for unrealized profits. Is that clear?
Yes, sir.
So, $1,300 and then
add back depreciation 500.
You know how they got that 50-50, I suppose?
Oh,
50.
sorry, 50.
How we got 50? Is there a note for that? What I will do, 1,200
Yeah, there's a note.
divided by
Depreciation reduction is calculated as
$1,200
$1,200
by 8
divided
years.
by 8 years, and that into 4 by 12.
Exactly. June, July, August and September. Right? Therefore, there is a reduction in your depreciation expense and that will increase your profits. So, 1,200 by 8 years life, you will get the per annum depreciation, that into 4 by 12. What is the amount? 50 added. Now, how to find the PUP?
It is
Remember, $2 million, or 2,000 in thousands, right?
Yes,
With
sir.
me. On that, what is the profit you made? 20?
5%.
On cost.
Yeah.
So, into 25 by?
No, on sales. 25 by 125.
That's what? 25% on cost.
Yeah.
That's why 25 by 125 on sales.
2 million is a sale.
Yeah, that's a sale value. That's right. 2,000 into 25 by 125. How much you get?
$400,000.
Should be reduced because the profit not yet realized. So 1,300 add a 50 minus 400.
950.
That is a right amount of post acquisition profit.
Retained earnings.
That is your post acquisition retained earnings or the profits made by the subsidiary company. Got it?
Yes, sir.
950,000. Of this 950,000, 20% belongs to you people and 80% belongs to my people. My people means a holding company shareholders, right?
Yes, sir.
Now we shall go ahead and take on
Working
note number 3.
Good.
Very simple. Now first I got to calculate the consideration I paid you people. Remember I offered 3 for every 5 shares. We saw your company has around 5,000 shares in thousands.
Yes.
Remember share capital was given as 5,000 in thousands and face value $1. That means you have 5,000 shares in thousands. What I will do, just see the calculation. Payment in shares. What I will do, 5,000
into 80%.
into 80% what I bought. I bought 4,000 shares from you people. That into 3 divided by
5
is the exchange ratio.
into $5.
I will get around 2,400 shares are offered to you people, to the shareholders who sold the shares to me, right? 2,400 shares into
$5.
$5 per share.
12,000.
When I say 2,400 shares in thousands, fine?
Yes, sir.
So into $5 per share. So 12,000 is a consideration paid in shares plus cash payment given as 800. In all, it is going to be 12,800 is a fair value of consideration I paid. To this add a fair value of non-controlling interest given as a 3.5 million. Nothing but 3,500 in thousands. What is the grand total?
16,300.
From this, subtract the fair value of net assets acquired. How much?
It is the 7,000.
That is a fair value of net assets at acquisition date. So, what is the net amount?
We have 9,300, which is goodwill.
That is excess. This is nothing but your para 32 of IND AS 103. Is that fine?
Yes, sir.
It is a para 32, paragraph 32 of IND AS 103, where the first set of numbers is greater than the second. Then that is called goodwill. So how much? 9,300. Very good. Now let's go to working note.
4.
For non-controlling interest. Very simple. Take the NCA on acquisition 3,500. To that add non-controlling interest share in the post-acquisition profits will be 950,000. Remember we calculated.
Yes.
On that 20% how much? 190.
190.
In all 3,000.
690.
690 is the amount of goodwill, or rather non-controlling interest. Okay, I'm really sorry. 3,690 is the amount of non-controlling interest. Now we go to the last working note for the balance sheet preparation. Just see,
Consolidated retained earnings.
very simple. I take my retained earnings, how much?
12,300 given.
Very good. To this, what do you do? Add,
The Sanford post-acquisition
which is $950,000 into 80%.
760.
That's it. Total.
13,060.
That is all. We're all set for the balance sheet now. But have in mind, please go to the balance sheet, the question, Renuka.
Yes, sir.
Now tell me, what is the current liabilities given in my books?
15,000.
In my books.
Yeah.
This will include 350,000 trade payable. Is that fine?
Yes, sir.
Have this in mind. And what is the amount of current assets given?
It is 2,400 in my books. Like
In your books. Receivable, right? Have this in mind. Now we'll start with the balance sheet. Yes.
Yes, sir.
Solution.
So balance sheet, first non-current assets. Another property, plant, equipment. To 25,500 plus.
Take my property, plant, equipment.
13,900.
Plus your property, plant, equipment can be
Minus
taken.
1,200 fair value adjustment.
From your property, plant, you can minus 1,200.
Plus 50 fair value adjustment.
Exactly, because depreciation adjustment, right? Add back 50. That means to your property, plant, how much?
13,900 minus
from that minus 1,200 plus 50. And then add it to my 25,000.
500.
You'll get the property, plant, equipment for your consolidated balance sheet.
38,250.
Next.
Goodwill.
What you got?
9,300.
Very good. Then
Investments.
how much?
1,800 minus 800 consideration.
Because that has been taken for already computing goodwill, remove that. Take only 1,000 other investments.
Plus
this
300 gain on FVOCI.
Exactly. Remember, you'll pass an entry investment account debit to fair value reserve OCI as per IND AS 109. So 1,300 is my investments, other investments which are fair value through other comprehensive income. Next.
Current assets 12,500 plus.
My current asset as it is you can take. Okay. Then.
Plus 2,400.
Plus 2,000. Remember, current asset will include even stock in trade. Remember, I have some stock on which profit is not yet realized. Remove the 400.
Yes.
Have that in mind. Okay. Current assets, how much? My current asset 12,500. Have this in mind.
Plus
what about your current asset?
400.
Then.
Plus 130.
Okay.
Minus 130 cash in transit.
Okay.
Minus 350 intra-group adjustment. Then minus 400 working note 2.
Okay. Plus 130. Then.
Minus 130.
Minus 130. Then.
Minus 350.
Okay.
Intra-group and 400 working note 2.
Did you understand this? Maybe you're slightly confused. I'll tell you how it works.
The 130 is not included, so I'm including first, then excluding because it's
no, I'll tell you what is the reason. In fact, you can do this way. Okay, listen to me. I'll tell you how it works. Okay, guys, have this in mind. Now, tell me what is my current assets, Renuka? 12,000?
500.
This amount will include my inventory. And that inventory, what I bought from you includes unrealized profits, right? That means my inventory is what? Valued above cost. So you should remove
the profit.
Profits how much? 400. You find it subtracted. That should be anyway subtracted.
Yeah.
Okay, no problem. Then I'll come to the 350, 130, 130. Okay, what is that happening? I'll tell you. Now in my current liabilities, I have 350 payable to you people, right? To you people.
Yeah.
When I say that, I am Premier. You were the owners of Sanford, right? You were once upon, now you are non-controlling. So remember, 350,000 is a payable. But it's given that there is $130,000 what I wrote a check towards you, not yet reached you. What is the meaning? That means actually I owed you how much? 400 $80,000. How 480? 350 plus?
130.
I owed 480 payable. You also had a 480
Receipt.
receivable. Now what happened? I wrote a check for 130. I wrote a check. The minute I write a check, okay, what I will do? I will reduce my payable to 350. But you have reduced your receivable because what? You haven't received the
check it.
Exactly. So your balance still 480. What you should do? Your current asset includes what? 480.
480.
That's why remove 130.
30.
Remove 130. Okay. After minusing 130, what? Both have 350 payable and 350 receivable. Got it? So minus 130. Once you subtract 130 from 480 receivable, what is the balance? 350. I have a 350 payable, you have a 350 receivable. What are you going to do? Cancel both. Gone? Yes? Now, if you tally, it won't tally the balance sheet. Why? Still, there's 130 checks in transit, right? In transit check also is what? Is a part of cash and cash?
Equivalent.
Exactly. It's a part of cash. Please add it to current assets. That's why they added 130. Got it?
Yes.
Now check this, okay? I repeat this point. I had a 480 payable. You also had a 480 receivable. The minute I write a check, what happens? It comes down to 350 payable, but you still have a 480 receivable. What you should do? Please remove 130 because the reason is I wrote a check. Yes or no? So you should account for the amount check to be received. If you remove 130, what happens now? It is going to be 350, 350. Cancel 350, 350. But balance sheet will not tally because still 130, the check is in transit. So please add 130. Is that clear?
Yes, sir.
Understood?
Yeah.
Yes? Okay. Have that in mind. So please remember.
Basically, Sanford is removing from debtors
Very
and adding it as a cash.
Exactly, my dear friend. What you should, you can also do this way. Remove 350 from trade payable. What? Remove 480 from your receivable. Got it?
Yes.
Remove all the 480. Then add what? 130 as cash and transit. Understood?
Yes.
You're right. You are removing all the 480 from your balance sheet, Sanford balance sheet, and adding 130 as what? Check in transit. Got it?
Yes.
So that's what they're done. 12,000 how much?
12,500 plus.
Then
2,400.
plus
130
130
minus 130. Then
and
minus 350.
is as good as minusing 480, no?
Yeah.
Minus 130 minus 350 is minus 480. And also what? Minus 400. Inventory, the PUP, and what is the net amount?
It is 14,150.
Then go to the total.
Total is 63,000.
Then equity and liabilities.
Equity share of $1 each, 12,000 plus 2,400.
You know why? Remember, my man has 12,000 shares already. Remember, I issued 2,400 shares to you people, not accounted for.
Yeah.
So add 14,400 shares of $1 each. So amount is 14,400. People ask me, sir, you issued 2,400 shares at $5 each.
Market.
What about the $4 extra?
Premium.
Exactly. I'll go securities premium. Yes, ma.
So equity share is 12,000 plus 2,400, 14,400.
In thousands, okay. That into $1 share.
Then share premium 9,600.
That is nothing but 2,400 shares into $4. 9,600.
Then other equity reserve 500
Plus
300 gain on FVOCI.
Exactly, 800. The
Retained
retained
earnings 13,060.
Remember, in examination, what you can do, you can add up all the three numbers. Which one? Your securities premium,
other equity reserve, and retained earnings.
all put together will be labeled as other equity. Is that fine?
Yes, sir.
Next.
The next is the non-controlling interest 3,690.
690 what you got.
Then current liabilities 15,000 plus 6,800 minus 350 intra-group balance.
That is all.
21,450 in all 63,000.
Is that clear?
Yes, sir.
Yes. Okay. So with that we complete the balance sheet part. Now we have to take on, you know, the statement of P&L.
Working note 6 and 7.
Now please remember, you have been selling goods to me $1 million or 1,000 in thousands. You have been selling $1,000 worth of dollars in thousands, okay?
Yes.
$1,000 every month. Now what is sold post acquisition matters. Pre doesn't matter. No, we are strangers, right? So the intra-group sales, how much? It is $1,000 into the last 4 months. June,
4,000.
July, August and September X0. So $4,000 will be a part of your sales, right? And my cost of sales. Because what is cost of sales? Opening stock plus
Yes, sir.
purchases plus all other expenses incurred for manufacturing goods minus any closing stock, right? What do you study in cost accounting? Same thing. Now here please remember, your sales will include $4,000 intra-group sales, and my purchase will include $4,000 intra-group purchase, right? Which can be eliminated. Very important. Got it? And one more thing, I will start to consolidate P&L only from 1st June onwards, not before that, right? I cannot consolidate your profits or your P&L account with mine before 1st June. Have this in mind, and then we can take on the statement of P&L, Renuka,
Yes, sir.
and then any working note we'll see the difference, okay?
Yes.
Yes. Start with the statement of P&L.
Consolidated statement of profit or loss and other comprehensive income for the year ended 30th September 20X0.
Yes.
Revenue 92,500
My revenue
Plus-
is taken as a whole, fully, and yours,
45,000 into 4 by 12 minus 4,000.
you saw that I'll take
sales.
only 45,
1,000 into 4 by 12.
the last 4 months sales. I assume that the sales are made evenly through the year. That is how some you normally make. So 45,000 into 4 by 12, how much? Will work out at 15,000. From that, please remove the intra-group sales. What you sold to me?
4,000.
Exactly, 4,000 is subtract. What is the net amount?
1,03,500.
And that is sales to be recorded. Next,
Then cost of sales, working note 6, 78,850.
let's go to the working note. You take my cost of sales as
Yes.
it is. How much?
So Premier it is 70,500.
Remember that includes a 4,000 intra-group, okay? Then
Sanford 36,000 into 4 by 12, 12,000.
but please remember from this, yes ma,
Intra-group purchases 4,000 subtract.
because
Then-
intra-group, right? Minus 4,000.
PUP in inventory working note to 400. And
You have to create a provision, therefore increase in expense. When you create a provision, what is entry? Profit and loss account debit to provision for unrealized profit. It will increase your expense, right?
Yes.
That's it added. What is cost of sales? It's an expense item. Therefore, you add the increase in expense. How much? Provision 400.
400.
You add.
Reduction in depreciation charge negative 50.
Here, please remember, since you are preparing a P&L, depreciation for the year would have been added to cost of sales anyway. Got it? So, what is cost of sales? Opening stock plus all your cost of goods produced, purchased, whatever, right? And then all the factory overheads all put together. Therefore, please subtract depreciation because it's a reduction in your expense. Got it? Therefore, minus how much?
50.
50.
78,850.
That is the amount to be taken as cost of sales. Got it? And here, please remember, you do not find depreciation separate line item in the P&L given in the question. It will be a part of cost of sales, being depreciation on plant and machinery, it will be a part of a direct expense. I mean, rather factory overheads, right?
Yes.
Next.
So P&L.
Let's go to the P&L. GP.
So next, gross profit is 24,650.
Because it's given, right? GP. Next.
Other expenses 12,000 plus 5,100 into 4 by 12.
Into 4 by 12.
13,700.
Okay.
So we get the profit for the year 10,950.
Till that it's all fine. That is a profit for the year 10,950. But remember, this 10,950 should be broken into two parts. The profit attributable to the non-controlling shareholders' interest and the profit attributable to the shareholders of the parent company. Is that fine? Next.
Next is the other comprehensive income.
OCI shown.
Gain on FB.
Remember, my
OCI
investments fair valued. Investment account debit to OCI reserve. How much? 300. And total.
Total other comprehensive income for the year is also 300.
Yes.
Then total comprehensive income is 11,250.
Till that fine. Now I got to show the breakup. Yes.
So profit for the year attributable to equity holders of the parent 10,760.
10,760. How do you get that? What you should do? Have that as a balancing figure. Rather you find the profit.
For the non-controlling interest in working note.
There is a working note. Just see. Now tell me what is a profit reported by the subsidiary 3,900. For 4 months how much? 1,300. Have they shown that?
Yes.
Now from that what you should do? Please minus a PUP because we are from profits you can subtract. See to the expense we add, right?
Yes, sir.
Profit you can subtract 1,300 minus 400 and add a 50.
Reduction in depreciation 50.
In all 950.
50.
The same number you got as post acquisition retained earnings. Remember? On that 950, what is 20%? 190 belongs to the non-controlling interest.
Yes.
Now tell me what is 10,950 minus 190? It is 10,760.
760.
So please remember the profit attributable to the parent entity can be kept as a balancing figure. 10,950 minus 190 is 10,760. Next.
Yes, then total comprehensive income attributable to equity holders of the parent. It is 10,760 plus 300
Exactly.
plus 500.
10,000
760
760 plus
300
plus 300.
500.
Okay.
So 11,060.
What is that 500? What is that 500? Any 500 given? 10,000 10,760
plus 300.
Okay.
That's the FVCOT.
That's it.
And then 500.
Okay.
And that is 11,060.
11,060.
And then non-controlling interest from above is 190.
That 500 is not there. It was only 10,000 mistake.
Yeah. Yes, sir.
So guys,
500.
no, there is a devil's imprint. Look at the mistake. It should be just 10,760, profit of the parent entity. To that add, remember I revalued my investments at fair value 300 extra. So what is 10,760 plus 300? In all 11,060. That's it. Is that clear?
Yes, sir.
And what is that?
The non-controlling interest 190.
That doesn't change. 190. That's it. Over. So that is your statement of profit and loss, having two sections of profit or loss and other comprehensive income. So guys, with that we complete the solution. Please go through this really well. Okay.
Yes, sir.
Good luck.
Yes.